Welcome back. Earnings setting the tone on Wall Street this week. 13 Dow components set to report their second quarter, including McDonald's, Coca-Cola, Boeing. This will very well set the tone for markets. Joining us right now, SkyBridge Capital Partner and Senior Portfolio Manager, Troy Gayeski. Troy, good to see you.
Great to be on.
I want to get your take on how to allocate money in this earnings season. And obviously, Lindsay's got the goods in terms of where we are in terms of growth. But first, Anthony Scaramucci. This was your partner for a long time at SkyBridge. Right.
That's correct, yeah. He was the boss, you know. So
for how long did you work with Anthony?
Since July 1st, 2010. So Anthony bought our fund and hedge fund business out of Citigroup July 1st, 2010. So I got to work very close with him over the years. And he's an amazing guy, and it's a really spectacular choice by the Trump administration.
So you think he'll do a good job? What's his big value, you think, real quick?
Well, look, he's an incredibly effective communicator to the average American. I think what he's very good at is boiling down complex subjects like tax reform. And I think you brought this up in your show before. It's something that we all know needs to be done, but it's a complicated subject. Border adjustment tax, where should, you know, corporate marginal rates be? These are things that I think Anthony has a very special talent for explaining in the way that the average voter can understand.
Yeah, he understands it, and he also believes in the agenda.
That's right.
Which is really important. All right, earnings. What's most important this week, Lindsay? Tell us what companies we really should be looking at.
Well, we're going to get a lot of industrials and healthcare names this week. Last week, the banks really held court. We saw some of the big banks. I want to get your take really on the bank earnings, because I know you like that sector and you want to kind of put money to work in that sector. The earnings results were really mixed.
Yes.
Loan growth was weak for the bigger banks. The yield, the curve is a problem. But the regionals kind of did better because they're able to charge their clients more without paying the depositors more. Where are you at on that?
Well,
and the sector has underperformed the market up 6%.
Yeah, so just to be clear, so most of our exposure is in the credit of regional banks, community banks. So they're complex instruments called TRUP CDOs. So they're CDOs backed by the trust preferreds of banks, mainly regionals and community banks. And so if you look at the improving credit quality there, it's a very strong tailwind. If you look at the fact that every time the Fed raises rates, it's not only good for net interest margin at regional banks, better for them than the larger ones, but also good for the TRUP CDOs because they throw off more cash flow. And then our whole point since the election has been, if there's one part of the U.S. economy that Republicans, senators, Democrats, congressmen, and the White House all agree, is that regional and community banks are overregulated. That's one of the few places where you can count on meaningful regulatory reform. So you have all these positive tailwinds that really drive credit improvement. To your point, the broader equity story on banks has weakened substantially because the curve has flattened so much. I mean, that's the #1 problem. And the second problem is, of course, there isn't as much loan growth as people expected. So, you know, we're a little tepid on the equity part of the capital structure. We just don't see anything that can derail the continuing credit improvement.
Troy, we talked earlier about the beats on both the revenue line and the net income line. But if there was a sector that may underperform in this quarter, which one do you think it would be? Well,
look, I mean, energy's lagged for quite some time, but there could be a continual disappointment there for investors. I mean, a lot of people got on the energy rebound train. Energy's still expensive more broadly. And when we look at the broader oil market, it's still sick, right? I mean, you still have too much supply. Demand is growing, but you get marginal production from Nigeria and Libya. And even though fracking production should be a bit lower going forward than some estimates, say, 2 months ago, it's still, as soon as oil goes up, here comes the fracker. So, you know, it's been a laggard. We'd expect it to continue to be a laggard.
How do you want to allocate capital here?
Yeah, so for us, you know, the mission is to generate pretty consistent returns that aren't dependent upon equities and bonds. And you know, we're the first to say right now that the only way to outperform or even perform in line with equities is to be 100% long equities, right? So if you're going to do something different, most of our exposure is cash flow oriented, tied to the U.S. consumer and the housing market, and also more niche plays like the financial service industry. But more broadly for your viewers, we do think the next 6-12 months is a reasonable opportunity for European equities to at least perform in line, if not outperform directly the U.S. So that's one place that we've ramped up our exposure meaningfully the past 6 months. And, you know, when you think about it, it's very simple. Europe's been either a debacle or a galactic disappointment since the beginning of 2011. The last great environment to invest in Europe was 05-06. But you're finally seeing all the pieces of the puzzle come together. You have better growth. You still have an accommodative ECB. You have a meaningful valuation discount, much more meaningful today than, say, January of 2015. You also have very strong earnings growth. And, you know, tied to it all is getting back to oil. You know, Europe's a much bigger beneficiary of lower oil than the U.S. as well. So, you know, all we're saying is that, you know, let's say the next 12 months, S&P is up 8%. There's a reasonable chance that, the stock 600, the MSCI European indices can be up 10, 12, or 15. And the last piece of the puzzle there, too, is the political transformation. So, Europe is going to be a mess in terms of the politics, but if you look at the consolidation this year, it's really around more center or center-left candidates. When's the last time anyone could talk about France reforming?
Yeah.
Right? That's the second largest economy in Europe. It's been a long time, yeah. Right? Germany did their big restructuring back when Schroeder was in power, and there's a reasonable chance that France could as well. So all we're saying to investors who have been extremely heavily weighted to the U.S. for the past 5-6 years is now is a reasonable time to at least look at Europe to nibble a little bit. All
right, we'll be watching that. Europe and the U.S. Great advice. Troy, thank you.
Yeah, great to be on.
Good to see you. Troy Gayeski there, SkyBridge Capital.